Okay, why don't we get started again? So first of all, welcome back. Hope you guys had a fun evening. Probably you went out drinking, we went to bed. We're the old people, but hopefully you had a fun evening in Stanford. Today, we have a busy day. We start with something a little lighter, which is this session, that is mostly about new data that is becoming available, that I think is particularly interesting for PhD students because it's free. You're long on time. You have lots of hours to work because you're not teaching, you're not advising, you're not doing lots of things, but you're short on budget. And so public data, it's your friend. Also, it makes it much easier to start a project without having to wait 6 months to negotiate the contract, get the funding from the university and all of that. And since you have the low small numbers in number of projects that you can try for your dissertation, something fast where you can quickly figure out whether there might be results in there that you want or not, or even just being able to inspect what's in the data, it's a huge advantage. Then we're going to switch to something very different. So Melissa will come in and give the methodological lecture before and after lunch, and she'll stay for lunch. So she's going to talk about her deep learning research agenda, and then she will cover a new paper that is thinking hard about how do we do inference with outputs of these models. And that will bring us to the last session that is going to pick up a little bit on that, because we'll do an applied paper in geoeconomics using very much of those methods. But then it's also going to go in different directions for the economics. So that's the plan for the day. Okay? Okay, so why don't we get started with this one, which is public microdata. And first, let me say, Bruno Canavani, who is part of the GCAP lab, is a PhD student at Columbia, is really the hero that put all of this together. So if you have questions, contacting Bruno is the way to go. And Jesse, who's my partner in crime at GCAP, the two of them really led putting this together. I'm presenting largely because Jesse couldn't be here today. Yesterday, we spent a lot of time thinking about microdata and large-scale data that has let us do advances in economics by looking either at old facts and giving them a new interpretation, discovering that the way we were interpreting them, for example, in theory, was inconsistent with the data once you look more carefully, or just discover entirely new facts, places of the data where we couldn't go before because of the absence of the information. But we really focus on three things, right? We focus on commercial microdata, public macro data that is relatively aggregate, and I've argued that there is a lot of good stuff that you can still do with the public macro data, and then administrative data. Those are data sets, for example, for Antonio showed you what we use with the ECB in a collaboration. Those are all great data. They have advantages and disadvantages, but until recently, what wasn't available was microdata that we could just simply give to you. And that was a big limitation because for the reasons that I just mentioned. One, for a PhD student, it's a much harder access cost. Two, you don't get to experiment with the literature. Because, for example, when I assign problem sets, it's difficult to say, and here's the data. Maybe we can do it within the university given the licenses, but certainly we couldn't post it online. And so one big change that has happened in the US right now is that microdata for the first time is becoming publicly available. Particularly, and this I should be careful, is microdata for financial positions. Okay? And it's a project done by the US government. It's called NPORT. What it really is, you can see it here, it's a regulation that requires investment management companies to disclose their holdings systematically to the US government quarterly. So these are very much similar reports that in the past have been collected by commercial data providers, or that if you think of, for example, the ECB, that might be part of the reports that the microdata gets at the administrative level. But the advantage of these ones is they're publicly available. So you can go to the data.gov website, which if you have not seen, it's great until it lasts. You can download lots of US government data from it with APIs. And this is, we picked 2025 Q2. You have all the quarters. You can download these things. Now, once you download them, what does the data look like? It's quarterly, mutual funds only. So you're not going to find here hedge funds. You're not going to find either type of investors. But the advantage is a fully detailed portfolio reports on the holdings. So you're going to have very obvious things like the value, but also in which currency is it. And you're going to have full identifiers. So you're going to have ISINs and QSIPs. That's a big deal because ISINs and QSIPs are commercial. So very often, if you don't have a license, the provider might not give some of the identifiers to you. They're all there. That means that you can potentially take this data and match it with many other data sets that you might have available at the university or commercially because you have identifiers. Similarly, you have identifiers of the firm. You have the lay. You have country, maturity. You have a lot of information already baked in. And trust me, 10 years ago when we started these projects, putting together that information was heavy lifting. The fact that it comes prepackaged, clean to you, it's a pretty big advantage. You also have information on the fund side. So many of you might want to use for an identification strategy, variation across fund mandates. Is it a bond fund? Is it an equity fund? Is it part of the same fund family? So there's a lot of that information. The data is also very, very cleanly organized overall. So there's really two key files. There's an accession file and a holding ID. The accession file, you want to really think of it as it's the identity of a portfolio report. That's also important because a portfolio is a collection of assets that get managed by the company, but then it might be sold to the investors using fund shares of many different types. And it might be also sold as ETFs and as an open-end mutual fund. As an economist, we normally think of the unit of interest as the portfolio, okay? Similarly, the holding ID file has a lot of characteristics. And I know that this seems trivial to you because why wouldn't you have all of the security characteristics? Is it a corporate bond, an equity? Is it a derivative? In what currency it is? The maturity, the coupon? If you've ever tried to do this for a living, get that information accurately, it's a heavy lifting. So this is surprisingly good, okay? And we should be grateful that the US government is putting it together. Now, what we're doing, and part of the reason why this is the first year we teach this session, is we became aware of this data when it first came out. Then, as usual, things take time. But one of the things that we're trying to do with the lab and the summer school is to provide some public goods. And so the public good in this particular case is putting together a GitHub repository of code that has both the data downloaded, the data is free from the government, but also all of the cleanup codes. So that eventually what you get through that is you run the code and you get a finished data set that is well organized and ready to go into something like Stata, okay? Now, we're not quite there yet, but hopefully soon. And we're not using this for our own research. So part of doing this is sort of putting it out there for our own students, for other people that might want to use it. And eventually, I'm sure that we'll figure out that there is 10 bugs, there is some double counting, there is things that we need to rearrange. So think of it very much as an open source project where we hope that all of you will engage with it and send us back questions or things that you discover that aren't quite right and that need to be fixed. Okay, eventually, what does the data look like? So, for example, the top two positions here come from the Vanguard Total Stock Market Index Fund. You can see that we have the identifier of the fund. They're here. What are the securities? They're Microsoft Corp and Apple Inc. These are the accession numbers. You can see these correspond to the fund report, so they're identical. But then these are characteristics of the securities that vary. So these are, for example, the issuer lay. Here we have the identifier of the ISIN of the security, the QSIP of the security, the currency, and then the currency value, which means the amount of that security that that particular fund holds at that date, okay? You can get a lot more columns into the data set, but these ones are essentially 90% of the information that you will need if you want to start thinking about how is this fund investing across funds. For example, you can see that if I skip this position and I go down here, this is instead the Vanguard Total International Stock Index Fund. They're holding Alibaba. So Antonio talked a lot yesterday about Alibaba and Tencent and the VIEs. And you can see indeed that if I look at country, the Caymans show up. Okay? And the ISIN starts with US because the security that the fund is buying is listed on the New York Stock Exchange. Okay? That's pretty extraordinary to get this public and clean. Now, the first thing you do when you get microdata is you figure out, is it good? Commercial data in particular, I'm sure that Antonio went through it yesterday, has many advantages and some disadvantages. The biggest disadvantage is because there's non-administrative data, there isn't a law that says that you have to disclose the data, it has to be correct, and it has to be comprehensive. Coverage is always an issue. Are we getting 10% of the universe of the funds? Are we getting 95%? If we're getting 70, is it a random sample and we don't have to worry? Or is it skewed in particular dimensions? And is the dimensions in which it's skewed correlated with anything that has to do with the results that we're trying to put together? So one very obvious thing to do when you get these data sets is benchmark against public macro data, against the aggregates. So here all I did is I summed the position. So these are all of the equities, values, and bond values in the sample. So you can see that the one disadvantage of this data is the sample is short. The legislation that forced these disclosures is relatively recent, and it's only US. But there's a hell of a lot of research that you can do with a few years of US microdata. In particular, think of anything that is really cross-sectional, a couple of repeated cross-sections to make sure that the results are robust, say, before COVID and after, or with some particular dates. It's all you need. Then you take them for a spin. So the first thing we did is we looked at the flow of funds. The flow of funds is the national statistics of the US that look at various sectors of the economy and how they're related to each other. And so they include positions. So here you can see by total assets, this is in the flow of funds, the part that gets reported as being owned by mutual funds. The data matches up remarkably well. You can then split them by equity and debt securities. And again, that gives you a lot of comfort that this is it. I mean, it looks pretty complete. Now, of course, as you go farther down, the biases might show up. You can see these are very large numbers. So some of these gaps are pretty substantial in dollar levels, even if in percentage they're relatively small. So one of the things that we did is, OK, let's have a look at a few subcategories. And so, for example, for treasuries, I think this came up yesterday when we were discussing it. You can see that NPORT is above the flow of funds. For corporate and foreign bonds, you can see they're pretty close. In general, public macro data you also have to worry about. You never take public macro data as ground truth. Why? Because very often it's based on surveys, very often it's based on sampling. Not all public data is essentially fully administrative, clean data, micro data, aggregated up beautifully. A lot of the time, rightly so, the statisticians have to do imputations. They're getting some subsets of the data. In the particular context of the US, what is a little disappointing is that the US doesn't have a great administrative data set for domestic holdings, which it's somewhat shocking to me, given how big the markets are and the fact that during the financial crisis, we discovered that who owns what around the country can make a large difference even to the macro performance. The US traditionally, Antonio went through it yesterday, has an amazingly good data set, way ahead of other countries, particularly in terms of when they started, on cross-border holdings, on anything that crosses the border. US residents owning assets abroad and foreign residents owning assets in the US. And by assets, I should really be careful, I mean securities. But domestically, that data is not as good. So a lot of the flow of funds has many more imputations. Okay? And so it's not quite the gold standard. That's very different from where Europe is right now. Immediately after the sovereign debt crisis, Europe started a big project to know who owns every security in the European Union. Sorry, the monetary union. And that includes all of the domestic positions. So a lot of the work that Antonio showed you yesterday that we've been doing in collaboration with the ECB has been loading on that data. So by now, I would say the European data is actually farther ahead than US data in terms of quality, because you can look at everything cross-border, but also within the European Union. That's not true for the US. This is the foreign data. So I just mentioned that the cross-border data in the US is very good. The Treasury does an incredibly good job together with the Fed in getting the micro data and putting together a national statistics by aggregating the actual micro data. And the micro data is very comprehensive because the reporting requirements are strict and they're well enforced. So one of the things that we did is we looked at all foreign assets. And you can see that, again, there are some discrepancies, but pretty good overall. Foreign equity and foreign debt look pretty decent. So this gave us a lot of comfort that if you're benchmarking aggregates, we're not getting wildly off numbers. Okay, and just to form expectations, when you open one of these data sets at random, that's not what they look like. Okay, you're going to be way off in levels. There's going to be some very strange, bizarre spike. This is not what normally happens. So these I would take as extraordinarily good news. Okay, okay? Very often in the lab, when we have young arrays come in, one big thing is everything is going to be off a little bit. The lines are not going to be perfect. So what's big and what's small? This, small, looks very good, okay? Bad is one line would be here and another line would be up here. That is not uncommon when you're trying to look particularly international data, and then you have to work hard on reconciling. So one issue is, of course, this is only mutual funds. That was also true, for example, of the work we did with commercial data. Eventually, we got the insurance companies collaborating with the ECB. We got all investors, but particularly when you start with commercial data, you're not going to have the universe of all holders. You're not going to cover hedge funds well. You're not going to cover some of the households. Some pension funds are not going to disclose. Private equity is going to be a problem. That's all there. But the fact that non-bank financial intermediation has become so big in most of the Western world, and particularly in the US, it's sort of been a friend to research, because it turns out that the one sector that we have much better hopes to cover cleanly, it's also the sector that has become the biggest over time, and it starts to dominate almost everything else, at least in terms of positions. That doesn't mean it's the most important for prices, because who's marginal, who knows? But if you wanted to if you wanted to recoup the aggregate positions, and you had to pick one investor class, you would pick the funds. You can see it here, because there's such a big part of the data. And this has become more and more true as we move towards passive investment, and all of the ETFs and the very simple open-end funds have sort of skyrocketed in values. If you think of the US with Dodd-Frank, we transfer a lot of the security holdings away from the banking system into the investment management groups. And that one for research has been a good thing in terms of ability to get data. Because the mutual funds traditionally don't think of their positions as being that secretive. In fact, most of the commercial data was originally collected because the funds do disclose at the end of the quarter the position. And so the commercial providers were simply just collecting the reports and aggregating them together. On top, they might get more private disclosures because they have a relationship with the fund. But a lot of it goes on some website somewhere. And it's a question of collecting it timely and cleaning it. But it's pretty important to have a sense of the magnitudes. But in shares, the mutual funds are so big. Now, if you were doing domestic, things would be a little different. The insurance companies in the US are very large holders of some assets. In particular, they're very big for corporate bonds. So depending on exactly the market that you're looking at, there's variation in who are the biggest players. But cross-border, and particularly in equity, the mutual funds are very big. OK. Then we can go farther. We can say, OK, let's start looking at finer and finer splits. So one of the things that I would like to teach you, even it's sort of almost trivially simple, but once you do it for yourself, even things that are trivially simple take a little bit of time to speed up your own research, is you start from the aggregates, then you start going finer and finer. As you go finer and finer, problems start to occur. And they tend to be of two types. One type is that the definitions become much more important. You and I can say, let's split corporate bonds, agencies, and asset-backed securities. Seems totally innocuous. You and I will code it, and we will get different answers. Because there's going to be a lot of bonds that are going to be a little tricky to classify, and the data sets are going to disagree. And so as you go finer and finer, that kind of noise starts to emerge more and more. And so at some point, when you do the benchmarks, you're not quite sure whether there is a real discrepancy or is the exact definitions that we're using that are starting to be a little far off. Okay? So your margin for error and tolerance for things being a little far off is starting to increase compared to the aggregates. Okay? But here, what we take, the data from TIC discloses 4 currencies plus a category called other. And we said, OK, let's have a look whether for US mutual fund holdings of foreign debt by currency were in the ballpark. Now, of course, we studied yesterday that US funds hold a tremendous amount of dollars abroad. So you can see that about 75% of the holdings are in dollars. So what if we drop that and we inspect a little better how we're doing on the smaller shares? And it's pretty good. I mean, we're pretty damn close. So no issues there. Now, what if we said, okay, I don't want to just benchmark against mutual funds. I want to know if I only have the mutual funds, how far off am I going to be compared to the full aggregates, including all other type of investors that are included in the administrative data. And you can see that things start to being a little bit farther off. Namely, normally, there is the following type of effects. Insurance companies tend to be much more dollar heavy than mutual funds. Right? They're an asset liability matching business. They have policies on the liability sides. They're all in dollar. They're looking for dollar assets domestically and abroad to hold against it. Okay? It would be even more true if we were including equity. Right? Insurance companies don't own a lot of equity. So if you're summing equity and debt, you will get the split wrong. So one trick that you can always do with microdata is you can think about going down to a level of disaggregation where the data is much more representative, and then using the aggregate data to do the weighting. Okay, so think about it. For example, you might be pretty good at getting the bond equity split in mutual funds, but you know that that particular split is going to be horrible for insurance companies. So if you want to go up one level, you might want to use the aggregate data to reweight with the information of what the debt equity split is for the insurance companies. So you can play with aggregation to make sure that you're maintaining a representative data set, depending on the application. If we look at equity, generally it's pretty good. You can see that there is a bit of off on the Cayman Islands, but in general it looks pretty good. Again, these things are surprisingly close, okay? It's very important when you do research to have a sense of the magnitudes. This is good news, okay? You're not gonna get a perfect fit. Then the question becomes, okay, what if we benchmark it against the commercial data? In particular, a lot of commercial providers are gonna also use Endport to validate their own data. They're using it in the back end and collecting the data. So here what we did is security by security, rather than doing some aggregation, we went at the ISIN level and we said, let's merge it with the commercial data we have and see if at the ISIN level we have a lot of agreement. And you can see it's remarkably close, particularly for the large positions. Now, this graph cuts the data on the smallest 12.5% of the data, because normally as you go to smaller and smaller positions, the level of noise is going to go up a lot more. There's a lot more misreporting of small positions than there is on large positions. Think of it like everybody's going to get largely right what they own of Apple or Microsoft in equity, but some obscure bond security that they own 2 millions of, there might be a lot more noise, okay? So normally when you use this kind of microdata, you try to look at the results, also value weighting, to just sort of avoid having the small positions by count doing a lot of the lifting. And you can see that there is a bunch of noise here, but overall it looks remarkably good. So our own take was, if you were one of our PhD students and you wanted to write a paper, a great idea on microdata that requires the US, this data is totally usable, and it's free. It's a pretty large shift in the availability of data compared to what we've seen for the last 10 years. Okay, so questions, and then I'm going to go through an example of taking what we did yesterday and just redoing it with full microdata. Please. Yes, so there are certainly misses on either side. We have not fully investigated them. I also suspect, I have no direct knowledge of this, but I suspect that over time there's going to be more convergence, because if I were a competent sort of commercial provider, I would be looking at this data. Morningstar, for example, 2 years ago when this data first came out, put out a report where they were comparing. FactSet was another large provider of commercial data. They're extremely good at picking up all bits and parts of information around the world to make their data set better. So I think that that's also going to happen naturally. At this stage, there are still differences. We haven't investigated them carefully enough to give you an answer, but you can see them. You can see them here. There's a bunch of, one of the two data sets is at 0 and the other one isn't. That little corner is telling you that there are a few.
Are there firm identifiers that you can merge?
Yes, so there are lays. So this is quite important because you can merge to CompuStat, to real data of the firm. There's two ways to do it. One is to use the lays. The other one is because you have the QSIP and the ISINs, you can use external information to go from QSIP and ISINs to the firm and then use anything that chains firm identifiers. So I'll give you some examples. I might want to aggregate from the QSIP 9 to the QSIP 6, then figure out the equity that is issued by the firm, march that one to a capital IQ ID because that one also has the QSIP in there. And then I might take that ID and march it to something else and I need to get to like a Norbis Van Dyke ID. So there's lots and lots of those crosswalks. It's non-trivial work in terms of you need to be careful, but it's totally doable. A lot of the time we have to do these crosswalks. Some of them are now becoming publicly available, not all of them, precisely because many of the identifiers are commercial, and so you can't just post them. But that's one huge advantage of having identifiers on both sides, on the firm and on the fund. You might be you're more interested in, I want to know something about the real side of the firm. But somebody else might be interested in, I want to know if these are all funds of Vanguard. And so the fact that you also have that side means you can aggregate the investors in interesting ways. There was another question.
Two questions. So again, quarterly since 2019?
Yeah.
Commercial, so Morningstar, they have anything on finer than quarterly data?
So a lot of Morningstar goes way farther back and also has a lot of monthly. When you go to monthly data, in all commercial data sets that we've seen, there's a lot more variation in who reports, whether they report all months. Generally, I would say the rule of thumb is quarterly, pretty good. Q4, nearly perfect. Monthly, you have to be careful with how the funds are coming in and out of the data set. Also, when you go away from the US, not all funds report end of month. So you have to be careful with the dates of the reporting depending on what you're doing.
Second question on cover. So back of envelope, this is 25%. So Nport has 25% of treasury markets, 30% of equity.
Yeah. I would really think of it as, from what we've seen so far, Nport has everything you need for mutual funds. Then everything else is a question of how big are mutual funds in that particular market. 30%. Yeah, which you don't necessarily need the micro data for. So the good news is you can do a lot of the information on how big are mutual funds in a particular market. You can get it from aggregate data. And so then the only question becomes, is this micro data close to the universe of mutual funds? And so far, the answer seems to be pretty close to yes. I mean, universe in this context means if you're at 90%, you're golden. It's not 50. I can't tell you whether it's 85 or 94, but it's in the ballpark where you put a footnote saying, is the near universe of the funds, okay? For anything of this size, you're not gonna get full coverage. Not even in the administrative data, by the way. It's not like administrative data is perfect. There's lots of little bugs in that one too, and decisions that you have to make. Okay, other questions, and please.
In terms of derivatives coverage between Nport and Morningstar?
We haven't looked so far. Derivatives are notoriously difficult. There are a couple of papers that have used Nports on derivatives, some of the simpler derivatives, like forwards. So that, it's obvious to all of you that are finance students, but maybe not to those of you that are not finance students. Derivatives are a derived security on an underlying. So you need a number of pieces of information to transform them into an equivalent exposure number. The way to think about this is if you've ever taken a derivatives class, is as economists, the closest thing to look at would be the delta, which is the derivatives of how quickly does the value of the position move when the underlying moves. Right? If you're long the stock, the delta is mechanically 1. For every cent that the underlying stock moves, so does your position. But if you have a call option, depending on how far you are from the strike, the delta might be very, very small if you're way out of the money, and the delta might be very close to 1 if you're very deep into the money. Unfortunately, almost always the way derivatives get reported, it's not in that form. They get reported as the notional amount, maybe the value of the contract. Those aren't obvious objects to look at if you want to, for example, combine them with a position. The fact that I tell you that I have a $20 million position in a call option doesn't really tell you my exposure, because it could be $20 million with a delta of 1 or $20 million with a delta of 0.01. And so far, nobody has been able to get clean derivatives data, particularly for the more complex derivative, and really transform them in a way that you will feel relatively comfortable, at least on a delta basis, summing it up with positions on bond and equity. It's a little difficult enterprise, because if you think about it, you would have to know things like the maturity, the strike, the notional amount, the vol at that time to compute the implied price, and all of that. But that doesn't happen. On top of that, our experience has been that even that basic information, it's either missing or extremely incomplete with inconsistent reporting. For simpler derivatives like a forward or a currency swap, people have done better. And so there's some very good papers that have gone into that direction, but that's where the frontier of the field is. Again, for mutual funds, you worry slightly less. It's not as if they do zero, but a lot of them, for example, that are very passive, replicating an index, are not going to do a ton of it. The ones that are like a PIMCO sophisticated bond fund that is doing very active trading, it's sort of starting to push the boundary between a mutual fund and a hedge fund, and their derivatives positions are going to be very, very meaningful in terms of their overall risk exposure. But so far, that's terra incognita for all of you to do the next great paper. Please.
And in general, if they have, because now in the derivatives market, there's a big chunk of trading that is with very short maturities, date to expiry, this would not be reported, right?
So these ones are snapshots. So think of this as this is the snapshot of the balance sheet of a fund at that reporting date. So if they have short-dated securities at that date, they're going to be included. But you're totally right that the persistence of those positions might be very different. So you might think that if I'm trying to get a paper on high-frequency trading, getting quarterly snapshots isn't that great. When you look at these big funds, the persistence of the positions is very, very high. And so quarterly, very often, it's great data, particularly for those of us that are more interested on the macro side. Quarterly is all I need. Very often, a few years of repeated cross-sections of annual, just to make sure that the results are correct, it's really all I need. But if you're doing something that has to do much more with the reaction to a shock, the reaction to a monetary policy change, then that frequency really matters. But monthly is really the best that you can hope for, at least in this context. Okay, great. So let's take it for a spin. So yesterday we went through this paper, which was the first paper we at least did using the microdata. And in the past, we would assign problem sets for this initiative. In fact, they're still online, that are sort of trying to get at that one, but aggregating the data enough that we're respecting all sorts of confidentiality requirements. And this is the first year that we could just say, well, here's the microdata. Just go run the regressions the same way and see what happens. So we had Bruno do exactly that. And so let's look at what he did. He took it. Of course, there is one issue, which is the denominator. Remember that that paper was looking at fraction of a security that a particular investor owns. Now, at the time when we wrote that paper, we really didn't have great data on all the amounts outstanding of all securities. But what we did have was mutual funds from many, many countries. Now, if you think of mutual funds as being the only investor in the world, the two are identical, because by market clearing, if you sum the positions of the fund, you will be getting the total. Now, of course, that's wrong. The mutual funds are first incomplete coverage, second only a part of the investor. But you could define, if I have all mutual funds around the world, the heterogeneity over the total holdings. So that's what we did. The denominator in that paper was total holdings of all funds, and then looking at the heterogeneity by type of holder. Here, you cannot do that because you only have the US funds. And so by now, we have built much better data on the security, the values of securities outstanding all over the world. And so what we ended up doing, so there's a tiny bit of cheating in terms of being able to do this by yourself with only the public data, is we ended up dividing the positions by the total outstanding. Now, the good news is that data is becoming much more routinely available to universities. Particularly for equities, it's trivial. For debt, for particular type of debt, there's a lot more heavy lifting to do. But for a lot of securities, you can get the amount outstanding pretty quickly, okay? So bear in mind the difference in denominators, because it's going to make the coefficients jump, because you're dividing by a different number. But for the rest, it's pretty similar. Okay, so I'm sure you remember this beautiful regression from yesterday after seeing 24 hours of content, so I don't have to go through it again, but I will. We're thinking about, for a security C issued by parent firm P, what fraction is held by a particular investor, in this case a US investor, a US mutual fund, depending on whether the currency of that security is the currency of the investor. So in this particular context, since we're doing a single country, is we're asking if the security is in dollars, okay? And we're restricting to corporate bonds. And we're thinking about aggregating. Now, the aggregation that we're gonna do for this exercise is much worse than the original one, or the one that Antonio showed you in the afternoon for the full papers, because we wanted to maintain it within the public data. So all we really did is we aggregated to the highest identifier within that data set, but that's not gonna be good enough, okay? You would have to go much farther and try, a firm might have, for example, multiple CUSIP-6s, and you have to know that they're connected, okay? Like, this might not be obvious, and it's a detail, but again, if you're gonna do this for a living, these details matter. CUSIPs are identifiers of securities. They have 9 digits. The last digit is a checkpoint, so it just checks that the CUSIP is indeed valid. The last 2 digits identify the security. The first 6, sorry, the 2 digits before the last identify the security. The first 6 identify the issuer. Now, when I say identify the issuer, it's a bit of a misnomer. They're one of the 6 digits are associated with that issuer. Because you can imagine just mechanically, if the issuer is very big and has issued a ton of securities over time, is running out of the last 2 digits. So at some point, they'll get a new 6-digit code, and they're gonna keep adding them up. So a lot of aggregating means taking care of those 6 digits and knowing that they're related. Here, we're not gonna do it. Okay? We're gonna do a much more naive of the best first pass that we could do to say that these are all bonds issued by the same entity, okay? Okay, so here's what it looks like. You get a very large currency effect. This is for a different year. The magnitudes should be off because we changed the denominators, but you find exactly the same results. And this one you can do by yourself. Similarly, we could go back to the triptych that we did yesterday. What if we wanted to replicate the classic result of getting home bias in securities? The idea that investors hold much more of securities issued by their domestic firms. And then we can say, okay, is that true also for currency, and what if we put them together? Okay, which is exactly what we played around with yesterday. And here's the results. Like, one of the things that I love about home bias is I love results where you pick any piece of data that is sufficiently reliable and these things pop up. That's what makes them really solid. I care a lot less that you can run exactly the same regression, get the 4-digit right. I care that this is a result that in whatever piece of data you look at is a big characteristic of the data. It immediately comes out. And you can see that home bias is one of them. Like, this is totally different data. We're 20 years away from when French and Poterba wrote their papers, and it's just such a big factor of the data. It shows up immediately. It's like running UIP for exchange rates. You run any half a decent piece of data, and you're going to find that UIP fails. I like those kind of facts. Now, here's currency. Again, it shows up pretty strongly. And here's when you put them together, and you find the same effect. That now, because you're going within group, the home coefficient drops down, and the currency coefficient stays up there. This is just an example, but it's to show you that things that 10 years ago would have been 2 years of heavy lifting, trying to get the data, and you would be at the forefront. Now they're becoming, okay, this took 3 weeks. And probably will take you a little longer because we've done this for a long time, so we know where the bodies are. But part of putting these repositories together is to fast forward you and say, look, if you want to write a dissertation next year and you need microdata, here you go. It's there, it's clean. Somebody told you that it's actually half decent. And hopefully we get to hear from you all the little things that are wrong in the cleaning codes. Or you might find particular dimensions. And you were asking me yesterday about the treasuries and NPOR being above. We'll look at it. It could be that the flow of funds is using some survey that is incomplete and is the flow of funds that is off. It could be that NPOR has some double counting, some values that are wrong that are particularly big in treasuries, and we'll have to look at them. But I think collectively, I suspect this data is going to become clean and routine the way the 13Fs, for example, have been. So I'm going to stop here and see if there are any questions. But hopefully, for those of you that want to do this kind of work, this will save you, 6 months of your life. 6 unpleasant months of your life. Please.
So in the plot that you did put up, did you drop one of ETFs or mutual funds when they were?
So I think what these ones do is that they counted both, but this data does not include the money market funds. The Morningstar data has them, but I think we excluded them in the benchmarks.